Thank you, everyone. Come on in, get cozy. It's going to be a packed day. I want to first and foremost thank God for not bringing the hurricane to Miami today. You know, a lot of people called us and contacted us, and they said, oh, yeah, but just to be fair, it was always people from out of town. No Floridians contacted us. It was always people from out of town who were like, is this still happening? And we were like, yeah. And we never got an email or a text from a single Floridian. This is like sort of an everyday thing. And I'm really grateful that we had the weather for it. I'm really grateful to all of you for being here today. And this is our largest event to date. We have over 5,000 people who've registered and bought tickets for this. And I'm super excited about that.
All right, how's everybody doing out there? All right, I'm Stuart Elliott. I'm the editor-in-chief of The Real Deal. This is our first panel of the day, focusing on development. Since there's no tropical storm, we're going to emerge from today at the end of the panels a lot smarter, but no wetter, which is great. Yeah, it's been a great couple of years for Miami real estate in the most unlikely of circumstances. The city saw supercharged growth during COVID and established itself as a Wall Street South. Besides Ken Griffin buying half of Miami, last year Florida saw the second biggest population growth in the country. Rents were up 45% in Miami, tops in the US. There are 9 super talls planned for Miami, including the largest development south of Manhattan. So the question really is, whether the good times will continue unabated. And the answer is, maybe not. Or at least the good times are going to look a little different than in the past. There are plenty of headwinds right now, from rising interest rates, to inflation, to construction costs, to peaks we're hitting in rents, that are going to change things up a little bit. So, how can we keep business going? The worst thing for brokers out there in the audience today is not pricing going down, but activity grinding to a halt. So, fortunately, we've got some of the most experienced developers in Miami on the stage today. I'm going to introduce them quickly. We're going to get to it. So first, Carlos Rosso. Carlos came on in Miami working for the 800-pound gorilla of Miami real estate for 2 decades, serving as the #2 guy at Related, bringing 16,000 units to market before he struck out on his own 2 years ago. And his One Park Tower condo project, Solomia, in North Miami, is part of a $4 billion master project by the Sofers and Lafrax. And he's building the first branded condo project ever for the Standard Miami, for the Standard hotel chain. And thank you, Carlos. Next, we got Bruce Eichner. After building the hugely successful Continuum condo tower in Miami Beach in the early 2000s, he waited a dozen years to come back to Miami. But he's back in a big way. He's got 2 condo projects in Bay Harbor Island. He's got a really big tower in Brickell that may or may not be happening. We're going to find out more about that. And a couple more announcements today that he just told me about backstage. So we'll hear more. Thank you, Bruce. And finally, we have Arnaud Karsenti, founder of 13th Floor Investments. After Surfside, his company's been pursuing a tricky strategy of buying aging condo buildings for redevelopment. Had a $500 million project with Related, and hear more about that. But as he told me, that's just the tip of the iceberg. 13th Floor has a prolific development across asset classes: commercial, residential, condos, commercial as well. Some $3 billion in projects overall. So welcome, Arnaud. Thank you. So, the hurricane that just happened, or was about to happen, didn't actually happen, of course, would have been the first in Miami in 40 years. We're also facing an environment right now where inflation is a factor for the first time in 40 years in a big way. And I want to ask you guys, what new set of circumstances has that created for you?
Well, I would say, can everybody hear me? Given the hurricane situation and given just the macroeconomics, I would like to take a line from my good friend Jon Snow and say that winter is coming. Mm-hmm. But fortunately, winter doesn't come to South Florida, as we all know. We have a one-season environment. And I think that we really are in a place where the macro is tough. I think a lot of you in the audience could attest to. It's a tough environment right now. Tough interest rates. Costs are still high. But South Florida still keeps to be kicking pretty well. I think our fundamentals are great. And I'm not referring to the soup du jour and the latest project that's making the headlines. I'm referring to the population trends that we're seeing from people really moving down to South Florida and making it their permanent residence, not just considering Miami and South Florida as a place for a second home, but really considering it as a place for permanent residency. And I think, frankly, the size of this crowd is an incredible data point for Miami's growth as well. So I think we're all going to have our challenges. I think every market has its challenges, but very few markets in the country have the amount of tailwind that we're seeing in South Florida. And frankly, we should be very fortunate to be part of that.
And Arnaud, I want to ask you, though, following up with that, rent growth of 45%, that one of the biggest drivers of inflation is rents, right? So on the one hand, as a rental building developer, you want to see rents go up, but at some point rents going up drives inflation, which then causes the Fed to raise interest rates, which then impacts new projects you can do. So is there kind of a sweet spot?
It's important to remember that we have been, unfortunately, one of the culprits of inflation in the sense that rents take up about a third of everybody's spend. And the other 2/3 you can't really control too much of. I mean, food, healthcare costs, other goods that are frankly not so discretionary. So we have been the beneficiaries of that. And so it's only normal that now we have to kind of reap what we sow to an extent. However, I think that the rental growth that you're seeing is based on real demand. So it's not based on a moment in time. It's based on a permanent shift of people wanting to be here. And the reality is we are in a supply-constrained economy down here. Mm-hmm. But I do agree with you, Stuart, that I think I would probably speak for Carlos and Bruce as well, that we'd rather see more tempered growth that's consistent over the next decade rather than these huge spikes that, while exciting, are also a little bit unsettling, and the pendulum tends to swing the other way.
Well, let's talk about the supply for a second, because that really impacts things, like you're saying. This is not a market like the Great Recession where you had hundreds of projects, right? I mean, we're more supply constrained now, or where do you think things lie on that front?
No, I think that the supply is definitely more constrained than in the previous cycle. There is a smaller pipeline of projects, and really you have two different types of products. You have the uber high-end type developments, and then you have more of what I would call the short-term rental projects. Those are the two categories that we see right now. We don't see a lot of bread and butter condos for sort of middle income buyers, and I think that on both ends, you have to be very careful with the oversupply, because they're building, in my view, too much of the same in the same place.
And do you think there's going to be a lot of new projects going forward? I mean, Bruce, I know you have an announcement to make today, which I want to hear more about, but what sort of interest rates are you guys seeing on new projects that you're doing?
Well, first, I think that one of the most significant changes in Florida, and it's not just South Florida, it's Florida, is the amount of business that has relocated to Florida. Historically, what came here were people. Businesses didn't come to Florida. And that has provided a very significant change to the landscape. You have people who want to live here and want to work here. And that will ultimately translate across the board. I think the other thing is that you got to remember that when you talk about real estate, the asset classes are not all the same. The catastrophe that's going on in the office market bears no relationship to what's going on in the residential market. Retail markets are valued completely differently than hotels. So part of what's going to happen in 2023 is different asset classes and are going to wind up being affected materially differently. And really, to Carlos's point, a third thing is there really is a difference between adding to the supply of, quote, $2,000 a square foot properties, whether it's an aspirational property in downtown Miami. or what Carlos referred to as middle market. I mean, we basically brought a building to market in Bay Harbor, never opened the sales office, sold all of the apartments in 3.5 months at an average price of $1,200 a foot. Now, Bay Harbor never sold anything for $1,200 a foot, but the apartments were of a size that were manageable. And part of the issue and part of the challenge is, can you find land in places where people want to be? And can you thoughtfully develop plans where every unit in the building isn't 4,000 feet, so the absolute dollar price is $5 million, and you basically, while you're in a great place, you've priced everybody out of the market.
So does that mean the middle market's kind of the sweet spot? Because I know you have another project in Bay Harbor Island, maybe you want to touch on, that would be more super luxury, right?
No, it's basically it's similar to the first building. Similar unit sizes, square footages, pricing. I think that there is a challenge for us to balance the issue of being a first mover or not a first mover against going places where people can afford to go, whether that affording is a rental or that affording is a condo. And by the way, financing for rental buildings in 2023 will be challenging.
And Arnaud, we were talking on the phone the other day. You said right now, you know, in this environment, you're a net seller. You sold something like $1 billion in real estate over the past year. Tell us kind of the thinking there.
Yeah, I mean, look, we're part of real estate. You have to remember is inherently a cyclical business, and the way it's designed, you have one of two choices. You could either be a long-term holder, which I think is a great model, and then you could be more of a what the industry refers to as a merchant builder, or more in the kind of private equity capital market side of the world. A lot of developers and investors fall in the second category. So when you see an incredible market like we have in in basically the last 2 years, it's kind of a moment in time that obviously is time to ring the bell. So we took advantage of that and sold about 3 times more real estate this year than we have. But that's not our way of saying that we don't love the market. If anything, we actually added even more pipeline this year than we ever have as well. I think that the other thing you have to consider is, real estate morphs and changes in terms of its level of disruption. So to Bruce's point, just like retail went through a huge period of time the last 10 years where the whole state of retail was kind of upside down and people would refer to retail as a 4-letter word. Well, now retail seems to have bounced back because people realize, while they want to buy online, they still want to go out and enjoy themselves, and they need places to do that. Well, now office seems to be going through that because of this disruption with Zoom and working online, et cetera. But I don't think the office is dead either. Interestingly, disruption can work in our favor, as is the case in some of these branded projects that are happening. I think it's bringing a level of lifestyle. I think South Florida is an environment where all of these kind of cases get tested, and we're in a good place to do that. So, but at the same time, when you see, just like when you sell your condos for $1,200 a foot, I'm sure you're eager to do that. Similarly for us, when we see cap rates at historical lows, we obviously we're pretty ready to take that opportunity as well.
I wanted to ask a macro question. So much of South Florida's history has been built, to some degree on hype. And right now you have, Ken Griffin, Wall Street South, Citadel coming in. Is that overstated, or are what's happening to Miami now real and really long term?
I think it's a huge change. It's a big change. And to what Bruce said, again, it's interesting to see how, when you look at New York and when you look at Florida and you look at different groups or different asset classes, the office market in Miami is completely the opposite of the office market in New York. Somebody told me the other day that there's around 90 million square feet of vacancy in New York. And we had another panel a couple of weeks ago with the guys from CBRE, and they were telling us the rates that they're getting right now in the office buildings in downtown Brickell. They're over $100 triple net. Those are historically super high rates for Miami. But again, it goes to what Bruce was saying. It's the first time that we see people and companies moving to South Florida.
Yeah.
It's an amazing moment for South Florida and for all of us. You know, it's the first time I see in my tennis club, I play tennis in South Miami, and I see people coming with drivers, you know, with black Escalades, with a driver to come and play tennis. And I tell them, so why do you have a driver in Florida? I said, well, that's the driver that I had in Manhattan. So we moved here and we brought the driver too, you know? We brought the Escalade and then we got a local driver. It costs a lot less than New York. But what I'm saying is that type of customer, we didn't have those guys here in Miami before. And look what's happening with other asset classes. Look what's happening with schools, you know? Those are, for me, the signs that, you know, we are in for a long run, for a great market, you know, when there's no space in private schools. And suddenly we start seeing avenues coming here and building a new school. And, you know, in Solemia, we are talking to 2 or 3 different school operators because we really want to have a super high-end private school. Because we think that that attracts buyers to come and live in a neighborhood where they can send their kids to a great school. So the drivers for each one of these projects are a little bit different. And I think it's trying to analyze holistically the market, what is happening in the whole market, and understanding what the trends are. And the companies are moving here, the rents of office are going up, the schools are getting filled, so all those people need housing.
And maybe drivers will be a big part of the buyer's pool. But let's talk about the election for a second, because, you know, a lot of this was driven by the Northeast, you know, coming down to Miami. And, you know, on Tuesday, DeSantis won by a big margin. Now, like, do you think that sends a message that, you know, Florida is not about red tape, which is good for real estate development? Conversely, you know, Florida becoming a more Republican state, does that drive away Northeasterners at all, or the political climate?
Look, I mean, we can speculate all you want. And I've made this point chatting with people in my company. Another thing that is going on in the United States is you have the greatest internal migration that the country's ever had. And if I look at the people, by and large, who are buying in La Bahia, they're coming from Boston, they're coming from Chicago, they're coming from the tri-state area. They're not coming from Florida. And that says something to me, because the ongoing issues for much of those sections are homelessness, crime, high taxes. And part of the reason that you've got both businesses and people is because Florida is perceived to be much safer. Obviously, it is a tax-friendly jurisdiction. I don't think that the overwhelming preponderance of whether they be businesses or individuals are going to be more moved or less moved by who the governor of the state of Florida is. I think they're moved by things that resonate with people, which are real issues. I think one of the real issues for South Florida is, I mean, we're all building luxury product. We're not building affordable product. And at some point, the issue of where do the people who basically represent the workforce, where do they live? And how do they afford to live? This is an issue that is going to be an ever-pressing issue for the next 10 years, and very little talking about it. Probably the most interesting side note on that was we just were approved to do what will be the first condo in North Bay Village on the Causeway. And part of the bonus that we received was to build workforce housing in North Bay Village. Interesting ask. something that the North Bay Village people never thought about before. So I suspect, and the approval that was just given for Hyatt for their new property in downtown Miami contained a $25 million, I guess, contribution by the developers for affordable housing. Interesting.
Yeah.
Where's it going to go? Who's going to build it? What does affordability mean? So I think that in addition to everything else, ladies and gentlemen, got to do a little bit of this.
Yeah. So that's going to be your Continuum 2 project.
You mean North Bay Village?
Yeah.
Yes, it'll
Yeah.
be a continuum. It will be the second continuum project in Florida. And God willing, the people who buy in it will do as well as the people who did in first continuum.
Yeah. But let's talk a point of comparison, because in New York, you had a project in Brooklyn. You said you would voluntarily do 40% affordable housing. The mayor came out and said, no way, we don't want this project, right? So it's relative.
You know, the mayor, Bill de Blasio,
Yeah.
not the mayor anymore. You know, you need partnerships. I mean, what government it doesn't do very well is generate new ideas. They do best when they react. If we are going to succeed, we need partnerships between the private sector and the government. What the government can give you is density. The government can give you tax breaks. The government can issue bonds. They don't issue ideas, they don't execute. So up to us, the private sector, to come to them with politically thoughtful ideas that provide a path for the stuff that we need as a society to survive.
Right.
Well, that's a great point. I mean, I couldn't agree with you more. I think that the government's real role here, especially with the private sector, is to create those partnerships, and that's exactly what we did with our Douglas project, our Lincoln Douglas project, which we have in collaboration with the Adler Group, where we basically took land that was obsolete, but on a train station, and have created what we believe to be South Florida's leading transit-oriented development project. And to your point, Bruce, what we did is we provided affordable housing in the form of 15% workforce. We provided beautification. We provided enhancement, activation of the station. What we got in return was density, obviously, which is the trade. And so government can give you what you know. Oftentimes, the government can give a nickel for what's worth $1, and vice versa to the developer. And in exchange, the developer can really provide a lot of these public goods that otherwise wouldn't be able to provide. Another big thing is parking is another big factor in all of our projects. Parking is a huge factor that is necessary, but also very costly and very space consuming. To the extent that you can leverage parking through public transportation, through multiple uses and shared uses, and also just reducing just car usage in general, which reduces the carbon footprint. Those are really big benefits that everybody wins from. Yeah. So I think the public-private partnership aspect is a huge element that I think will actually become more and more prevalent in the Florida market.
Well, I want to ask you about another public approval issue. On Election Day in Miami Beach, there was the referendum where Don Peoples, Barry Sternlicht, Steve Ross came forward. They all asked voters, hey, can we build bigger in Miami Beach? And the voters said no. What do you guys kind of make of that?
Yeah, but those were requests for more density on projects that were already pretty prescriptive. Those are not, those to me, those don't feel like trades that for the benefit of the cities, the way that when you, for instance, introduce a public park, or you introduce a transit, or you introduce workforce housing, you're really giving. See, the government's not just out there for more dollars. They want benefits. They actually need us to create for them the tools that they can actually help their communities.
So you weren't that surprised by that response?
I wasn't personally.
Yeah,
I thought it was a long shot to begin with. But I think asking for density just for the sake of asking for it is just it's a little different.
Right.
But not to say that we would go against that, because we obviously are pro-development, but I think that it has to come with another side. It has to come with a public good, oftentimes that is perceived in the government's mind as a as a win, as a bigger give than a take.
Right, right. I wanted to switch topics for a second and ask about, the trend of buyouts. After Surfside, there's a whole trend of buying out older condo buildings. Arnaud, you were trying play like that with Related, at the Castle Beach Club condo. It was a $500 million offer. Didn't work because there was some opposition there. Are you going to go back to the table, or what's kind of your thoughts about that play in general?
Well, first of all, I have to thank The Real Deal for making sure to tell me what's going on in our own deals, because oftentimes I can't keep track. And so it's great that we
our
can
team
just
over there.
kind of pick up the paper or the phone in the morning and I say, oh, we're doing that today. I wasn't aware. Look, there's no surprise that I think the opportunity to collapse condominiums and projects is definitely a next frontier. It makes sense. We're running out of land, and certainly beachfront land. And on top of that, you have this obsolescence of buildings. So you put all that together, and it creates for, unfortunately, it creates for potential disaster, as we saw last year, which was very unfortunate. It also creates for opportunity to be able to reposition and reposition buildings. The reality is, though, it's tough because you have owners of a lot of buildings who have different interests, and then they're also seeing costs go up in their buildings, and then you're also seeing, obviously, opportunity to develop on the land. The reality is, those I think you'll see more and more of those deals. They're going to be difficult. They all have their own ups and downs. You have to chase a lot of them, frankly, to convert.
Yeah.
And so I would just say, just be careful to believe what you read in those situations, because unfortunately it's a little bit more reactive.
Right.
But certainly we are working on a number of those deals that we're very excited about. And I think that's going to be a really fun part of our development cycle in South Florida.
Do prices go down because interest rates are higher, or what? Is there a calculus that changes to make these things happen easier?
There's no question the interest rate environment has put pressure on all pricing. I think that the stratosphere of high-end luxury is still strong, as you're seeing with sales. I mean, Bruce and Carlos were talking about sales in their projects. We're doing a number of them ourselves. We're seeing a lot of support, but in general, there's just money in the system is harder to come by. So I think that people are getting the memo, and I think condo owners are saying, okay, on one end, I want value for my unit, but on the other end, I'm facing assessments, I'm facing higher bills, and my unit is kind of falling apart. So there comes a tipping point where they say, I'm going to throw in the towel and sell. And I think that evolution is normal. But yeah, we're definitely seeing today a very different environment than we were before, and should translate to better deals.
And Carlos, you own several units, not as a developer, but as a unit owner in Bay Park condo in Edgewater. There was a buyout that was attempted there? How did that play out, and what was kind of your takeaway?
It's still it's a very hard process because you're talking of people's homes, and it's not really sometimes 100% rational. Mm-hmm. It's a very emotional decision. You're coming into a small town of its own. Each one of these buildings are small communities, and you really need the support of everybody, and you need the patience to convince everybody that this is the best for them. It takes time, and it's tough.
So, since we're all gathered together and I like to throw out ideas, another area of change are religious institutions. So we just made a deal in New York with a church. And the church membership used to be 1,800. It's now 70. And the size of the church is enormous. The facility is in poor disrepair. And I suspect that throughout the United States of America, that attendance in religious institutions, churches, the Catholic Church in New York is disposing of dozens of property. I suspect that one place that will be opportunities in Florida is as churches' attendance goes down and as their need for the facilities that they originally built 50, 60 years ago goes down. And since most of the churches occupy grade A real estate space, you will find that there is, over the next 2 or 3 years, if not over the next 10 years, also because of COVID, et cetera, remote attendance. It's not quite the aging condominium business, but it is a business.
Well, it's funny you should mention that because I know Arnaud is working on a project, site in Brickell, and you had gotten approval of the church. Then you had some people in the church who went up to the, I guess, higher Presbyterian council to try to buck the decision. So where do things stand with that now?
You should just read the real deal. I'll tell you.
Sorry, I didn't mean to tee that up for you.
Yeah, you definitely did. There's no question it's definitely yet another opportunity to take underutilized. I mean, the central theme here is taking these kind of underutilized, sometimes obsolete, sometimes just different types of uses and repositioning them, whether it's train stations or government parking lots or churches or schools. We actually recently also did a deal with Broward College where we're taking some land there, and we do that. Usually it's done through an RFP process. That project is obviously very exciting on Brickell. We're very, very excited about that. It's a waterfront site. It's kind of in the nexus of the Brickell area with the near city center, very near where Citadel just bought land. So we're very excited. Obviously, we can't quite disclose all the terms in detail, but it's something that we see happening in the next cycle that we are very enthused about that project. And again, it speaks to that partnership. That's the point I would want to drive, is that when you do a deal with a church or you do a deal with a municipality, it's not just about the dollars and the cents and the time and the terms. It's also about what matters for them and their constituents and their programming. And they have an agenda that is oftentimes complementary, but not always the same as the private sector. And I think those who listen to them and actually adhere and adapt are those who succeed versus just only thinking about it as like a buyer or seller.
And in this case, I might not have the numbers exact, but the church was $7 million in debt, and they're getting a $250 million payout. Is that? You don't have to confirm that.
There's some elements
there's
in
a
there
big
that
spread
resonate.
there.
Yeah.
What's the multiple IRR? They are going to ask you all these questions. You knew you were coming.
Exactly. Yeah, exactly.
Praying for it. So I want to get into individual unit sales at your projects. So, Miami-wide, I think we're seeing sales off by a third compared to last year, which is maybe not that surprising considering the run-up in the market. Is there anything you guys are doing to help buyers with financing or combat higher interest rates in any way?
I think that in general, we are all trying to get to our construction loans, particularly on the condo sites, and then once we have the loans, we can relax a little bit more the deposits on the last units that the jobs have. But we are all, I think, aggressively trying to go and market to different markets. We saw a resurgence of Latin American buyers, particularly Colombian, Brazilians, Mexicans, coming back to the market, even at the high prices that we have now. It took them a little bit longer to understand why the prices are what they are. But again, I think the trajectory of Miami and South Florida is going upwards. We are still a very small city. You compare a city of Miami is 500,000 people. You compare it to the city of Mexico, 40 million. So, and everything that we've seen this last 20 years has continued to appreciate and grow.
Yeah.
I think that the fact of the matter is that interest rates affect people who need to get a mortgage now. Most of the developments are developments that are coming to market in 2024, 2025. So for purchasers, on some level, you'd almost want to see the rates higher now, but on the assumption that they'll be lower later. I think the more salient thing for the market is the fact that a lot of people have gotten hurt in the stock market. I mean, the interest rates grew from basically 0 to 4% in 6 months. That has never happened in the history of the United States, and basically resulted in, among other things, an upside-down stock market. And there's been a significant loss of liquidity for X number of people. I think that translates into a certain, into the real estate market more than interest rates do, since most of these developments really aren't coming to market now.
And Arnaud, you're the most finance-oriented of the group. How are you thinking of interest rates 2-3 years down the line? Like, do you have a idea in your head of what might happen?
I'll give you two thoughts there. First, real quick, we actually have a home building business, and so interest rates are affecting that business more so than just about any business because it's affecting mortgage rates. And what we're seeing there is a shift to build for rent. So now the curve between buying and renting, this whole concept of why rent when you can buy. Well, now obviously with interest rates being high, it makes more sense to rent. So repositioning, same exact property, same exact asset, but now renting it rather than selling it. That's one strategy. The other thing is, what really I think is going on with interest rates and people that are buying right now, they're basically making a bet that this is temporary and that we're going to find some form of new normal. And their bet is that in the next 3-4 years, they're going to see rates go down where they can fix lower rates. And if they're wrong, they're saying that we're wrong because inflation will continue. And the reason why and because inflation will continue, our rent and our fundamentals will also grow. So they're either betting on the asset or the macro, and one of the two is going to meet. It's really the only thing you can do right now, because right now buying in this environment when rates are at 4% or so, which means that your borrowing rates are like closer to 6%. You're to be able to buy 4 cap or a 5 cap asset, you have a negative leverage situation. So you have to believe that it'll get better.
Yeah.
And on the pre-con side, on pre-construction side, we tell buyers there's no better hedge against inflation than pre-construction. I'm selling you something at a fixed price today, and I'm handing over the keys to you 2 years from now. Mm-hmm. So if you believe that there's inflation and that that's going to take the properties at a higher level, you're better off buying pre-construction today.
So what sort of deposit structure are you doing at the standard residences?
5 payments of 10% over the duration of the job, 20% by the time they sign contracts, and then in terms of milestones, 10% more when we break ground, 6 months after that, another 10, and 6%, 10% when we top off.
Probably the biggest elephant in the room, which I think we all know about, is where are construction costs going?
Mm-hmm.
Yeah, and I think that's back again to the interest rate discussion.
Yeah.
I think the multifamily developers are going to get hurt more faster than the condo guys. We are basically collecting deposits and financing ourselves at 0 interest with the buyer's deposits, and then leveraging up with a little bit less. Mm-hmm. But in the multifamily business, the mortgage has the construction loan has a much bigger impact on the underlying underwriting of the deals. Right. So if that side of the business starts slowing down, I think we are going to see construction numbers stop going up as they went in the last 12 months.
Yeah, and I was asking you about Hurricane Ian and the west coast of Florida, and whether that's, doing all the rebuilding there is going to drive up costs. But you were saying there might be a small
The insurance companies have still not started paying out. So we are lucky. We have a little window now to lock prices here for our jobs. But probably next year, at the end of next year, drywall, wood, it's going to start going up. And you're going to start seeing migration of particularly subcontractors moving to the west coast of Florida.
Yeah, and the one thing we were chatting about off stage is probably the most significant increase in cost for everybody is going to be insurance in 2023. I mean, between whether you are talking about insurance premiums for new building or the X thousand people that are in condominiums, and that insurance for next year, I mean, the numbers that I've been heard are 200% and 300%. The number of insurers that are fleeing the market is at a pace that nobody's ever seen before, and that is really going to impact single-family home builders. Anybody that has insurance is going to face a real problem in terms of finding an insurer and the cost of that insurance.
Yeah, that seems like it's going to be a huge impact going forward. I also wanted to ask Carlos, we touched on it for a second there, but the standard condo project you're working on, the Standard's first condo project from the ground up ever. What's the buyer pool there you're aiming at? Is it all, former guests at Standard, and what's kind of the play there?
No, I think we sold to a lot of people that follow the Standard and that are part of their membership program. The Standard is a very interesting brand. It's a very small brand, very boutique. They don't want to be the most expensive in the house. They don't think that luxury is necessarily driven by price. So it's a brand that I feel very much aligned with. They have like their own culture, if you want, and they're very meticulous about how do you create that ambience in a building. And the first time I met with Amar Lalvani, I known Amar for a long time. I've always considered him a very intelligent guy in the business. He comes from the finance side. He's an ex-Blackstone guy and an ex-Starwood, cut his chops with Barry Sterling before getting into the lifestyle business of the hotel. And he told me, hey, you cannot create this ambience with Airbnb. We don't believe in transit use in these buildings. There are two types of asset classes. There's hotels where people can come and stay for a day, 2 days, and we run the hotel. We have staff, we have a front desk, we control the experience of the guest, and then you have homes. And in between is some gray areas that can lead to problems. There's no other city in the world, I think, that is building 40-story towers for Airbnb. They don't exist anywhere. If somebody can show me, oh yes, they've done them in Chicago and everybody's happy with their returns, or they've done them in New York, it's exactly the opposite. Cities don't want them.
I will give a plug to the Standard. That's where the New York staff of The Real Deal usually stays when we come to Miami, which we really like. Do the spreads get squeezed there at all in the short-term rental game? I think there was one item that mentioned 7% returns if you buy and rent out. Like, does that start to get squeezed by treasuries? And treasuries are going up, and
I don't know. I really follow the advice of the hoteliers. He told me, hey, we'll give you the brand. We really like you. We've done deals with them in the past, but there are certain things that we won't accept. And we don't want transient use in a residential building.
Right.
So we try to elevate the project and position the project and create value. And how do you create value in a project like the Standard? It's very simple. We found a site that already had the parking next door to it. So the buyers at the Standard don't need to pay for HOA maintenance of parking, don't need to pay for insurance of that parking, and can use that parking whenever they want. So that, as a start, sets you one step lower in pricing than the competition. I always learned from George, what I was at Related, never be the most expensive guy in the room.
And the last question I want to ask you guys, and it harkens back to Related and the dark days of the Great Recession. So, Carlos, you started Related back in 2000. You went through the Great Recession. At that time, I think George and Related and you had $1 billion or $2 billion in projects that you gave back to the bank, and then miraculously you got those projects back through different funds. What are your takeaways from that world to this world today? Do you see any similarities in terms of what could happen?
No, I think the banks have done a great job, and developers also, in a sense, to de-risk the jobs. We ask for real buyers, and the only way to ask for real buyers is to ask for bigger deposits. There's no secret. Show me the money, and we went from 20% deposits where we used to allow people to flip their contracts to 50% deposits with no flipping. And that's the secret of what a great market we've had. We are doing less, but we're doing more secure and more safer projects.
Yeah. Thank God the banks were more cautious this time around. And, covering a lot of cities at The Real Deal, Miami is really bucking a lot of national trends. It's impressive. Arnaud, I want to end with you. Back in 2010, you had a distressed fund. Are you going to do something similar this time around, or what's kind of you have $1 billion in cash?
We might, and we're certainly in a position today where we're certainly opportunistic. However, I think the feeling's very different today than it was in 2008, 9, and 10. There, the world was really kind of coming to an end, it felt, and frankly, Florida was the epicenter of that distress. Today, we have issues, but Florida is like a beacon that's kind of head and shoulders above it. So I think there will be special situations that could be interesting, but I think systemically across the board, I don't see like Miami going for half off over the next couple of years. And I also think there's just way less debt in the system. So it's important to not confuse the fact that debt is hard to come by with the fact that there's too much of it. I don't think all of our banker friends are not complaining about how much debt is out there. It's just the volume and the transaction of it's kind of slowed down.
Right.
So we'll have
to see Miami go from a city of booms and busts to a city that, rides above the crest is pretty remarkable. Bruce, any last words?
Really, the point that Arnaud made, 2008 and 9 was a liquidity crisis. There was no money in the system. There was no place to get money. You don't have that here. You have expensive money. You have money that's looking for more equity, but there's not the kind of absence of money that existed. Do you want to take questions?
And plus, we have a lot more drivers now.
Well, I'm going to have you guys back in a year, and we'll see if you guys were right and we were right. So, thank you guys. I appreciate it. Thanks everybody out there.